Hello and welcome to episode 331 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leeks. Damien, welcome back. How are you doing?
I'm good, actually, Andy. I've been laughing off pod before we came on because Justin, who many of you will know, is obviously my twin and in the background of Money to the Masses. But he's on the camping weekend this weekend. And unusually there's been a storm, a named storm, hasn't there, that's hit the southern part of the UK. So I've just got visions of him trying to put up a tent as we make this podcast in 50-mile-an-hour winds, which I would really like to see. I know that's an evil thing to laugh at, but between siblings, it's perfectly acceptable.
Yeah, it's such a shame, really. I know you don't think this, but we've had some lovely weather over the last couple of weeks. Really still weather, nice sunny mornings, sunny evenings to sit around a campfire, enjoy a nice glass of wine, and enjoy a few days relaxing break. But no, Justin's got 50-mile-an-hour winds, squally rain coming in from the coast, and like you, I find it quite funny.
So if you want to be part of an atmosphere like that, actually, we have put out 2 job adverts. We were recruiting 2 more people for the Money to the Masses team, or as I'd like to call them, the family. So if you would like to be part of that, we're recruiting somebody to write more about investing for us. So we're expanding that part of the team, and somebody who's going to do a lot more on our socials and the marketing angle. So if you have experience in those areas, then do go onto the website. There is a link to careers at the bottom of the website. There you can find the job spec. So do apply if you'd like to come and join the Money to the Masses team. Before I go on to what's going to be on this week's podcast, Andy, I did want to quickly mention something that we had Lauren on the show talking about travel insurance. And there's, interestingly, we've had the pingdemic, so where people keep getting told to self-isolate. And there was a nice stat that I saw that came out this week, and it was from Defacto, who do the analysis of all sorts of products. And they said that 9 in 10 travel insurance policies cover the cost of cancelled holidays if the policyholder tests positive for COVID. But for cases of self-isolation, that cover falls to fewer than 6 in 10 policies that actually offer any kind of protection. So that was interesting follow-up to Lauren's piece that we did previously. So what is on this week's podcast? On this week's show, we've got 3 pieces. I'm doing a piece on the money mistakes to avoid in your 20s and 30s. It was something that I was asked, and I thought, well, let's do it. Similarly, I was asked by a journalist from a national newspaper about some of the things to keep an eye on when you're downloading or looking for financial apps. So that's budgeting apps, pocket money apps, you name it, investing apps. So we pulled together some things that we look at to double check before we download them. And finally, we're doing a piece on life insurance that Harvey's back on the show, which will be a fab piece. But importantly, she's talking about the times when you should review your life insurance policy. So there are scenarios that occur where you should go back and have them reviewed and see if there are better deals or if the products are still suitable for you. So that's a must-listen piece for people who have life insurance already in place.
Okay, great. So let's get into it then. Shall we start with the piece about money mistakes in your 20s and 30s? You're going to give some advice.
Yeah, so money mistakes in your 20s and 30s. If you're listening to this and you're in your 20s and 30s, don't worry, you're going to make loads of money mistakes. I made a lot when I was particularly in my early 20s. And this isn't a lecture. This is just a piece that's pulling together some observations of mine and other people's about things you probably wish you could have said to the person that you were in your 20s and 30s to make life a bit easier now that you're a bit older. So starting with the obvious, then don't spend more than you earn. And now that seems an obvious thing to say as a money lesson, but I didn't, like most people, really truly appreciate and learn that till later in life. So I was spending more money every month than I brought in. And part of that was because the second thing I'd want to point out to people is they're not tracking their spending. Now, back when I was 20, which was 20 years ago, there weren't the apps that were available now. I don't think the iPhone didn't even exist, but there are apps now that allow you to track your spending automatically by hooking up to your bank accounts. And there are banks that offer these services. So you get instant insight into where your money is going, what you're spending on bills, what you're spending on discretionary spending, going to the pub or whatever it might be. And I would say to my 20-year-old self, start focusing on what your money's going. I know you want to enjoy life. And yes, I did enjoy life quite a lot, actually, to be honest, in my early 20s. But going on to the next point is don't live off your credit cards. There is a temptation to live off your credit cards totally. That means accruing unnecessary debt. That means drawing money out of ATMs, so cash machines on your credit card is one of the worst things you can do because of the charges associated with that. But don't just think of credit cards as a means to just spend money that, I'll go on that night out because I really fancy it. There was a lesson that I learned later in life, which was that I put too much pressure on my future self to deliver on the things that I was doing in my 20s. So there was always a part of me in the background, and this is the same for a lot of people that thought, it doesn't matter, I'll sort that out tomorrow, or I'll sort that out when I earn more money. So that could be, I'll pay back my debt when I get a bonus or when I get a new job. All these things, you put pressure on your future self to deliver and pay back the money that your current self is actually spending. So you're borrowing from tomorrow for today. That is a recipe for disaster. There is always a crunch point. There's a point where you have to have a realization you've got to pay that money back, and that is painful, and that sets you back. I didn't, got accrued debt, enjoyed myself. Andy, you've talked about it on the podcast too, and it hampered future things that I wanted to do because I had to therefore just face up to that realization. Nobody else is going to pay that money back for you. So the tip is, don't live on your credit cards, track your spending and start to budget. The word budgeting is always loaded. It's very negative. So that idea of using the spending plan concept, think about where your money's going to go. The other one I wish I'd done in my 20s and 30s, and it goes back to some podcasts we've done in the past, such as the Millionaire podcast, which was podcast 283, is I wish I'd saved and invested money more in my 20s. Now, there was an interesting line that I heard the other day, that you need to learn to be able to save when you're broke. And the idea behind that is, if you have no money and you learn to save even £5 a month, £10 a month, then when you gain money, you will have that saving behavior ingrained and you'll start to save money. Because what happens if you can't save when you've got very little money, you won't save when you've got a lot of money. And that's a lesson that I even learned. So you live to your means when you get a pay rise. But if you learn, even when you've got very little money, to save £5 here and there, that starts to ingrain that behavior. And I wish I'd learned that when I was younger. And I think people in their 20s and 30s would do well to learn that lesson. And that's because there was the one thing in money that is something that I can't get and most people can't when they're older, is time and the power of compounding, which was at the heart of that Millionaire episode, being able to compound money with very little sums that can end up making you a millionaire in the future. So in your 20s and 30s, don't be the person who didn't put any money aside. Don't worry about the size. It's about the behavior of doing it, benefiting from compounding, pound cost averaging, all these things we've talked about on the podcast previously. If you don't know what they are, go and search on the Money to the Masses website. And equally, paying to a pension. Auto-enrollment has solved a lot of that for people, but still understand that auto-enrollment isn't going to be the thing that saves you in retirement. You're going to have to put more money into that. And we've looked at the numbers in the past, but some people have a rule of thumb of trying to put at least 10% of your money away for the future. Don't just save, invest. Now, one of the lessons is not taking enough risk when you are young, because you've got the ability to take risk if you don't need to access that money for a long time, particularly in your pension savings. So don't be overly cautious in your investments. Be bullish. Invest in equities. And don't think you have to invest in pensions. You can invest via stocks and shares, ISAs as well. But you've got to be strict on not accessing them without need. So if you're just going to use it to go down the pub and you don't want to do that. Not having an emergency fund was one of them, because we get to the point now, COVID has taught us all the importance of the emergency funds, but trying to build one when you're earning more money at a later date is quite difficult. Is if you build an emergency fund as you go along, as your wages increase, then you can naturally start to increase that emergency fund to reflect that ideal of 3 to 6 months wages, expenses, whichever metric you're going to use. Then it makes it easier. Make sure you've got an emergency fund, because things happen. That's the one thing you learn with experience, is things happen that you didn't want to happen, like COVID or whatever. You can't afford to pay your rent, you lose your job. So you make sure you've got a backup. Don't try and get rich quick. Now, this wasn't something that I did particularly. I was very quickly learned the idea that not getting sucked into some of the get rich quick things. But I think the problem we've got now is where people want to buy houses and they're seeing house prices go very quickly away from them. They're starting to take excess risk with things like maybe cryptocurrencies, or they're trying to see these things online that ultimately end up being scams to double and triple your money. So where I talk about don't be overly cautious, I'm not talking about being reckless. I'm talking about taking caution, but being boring, not expecting to earn more than maybe 5% above inflation on your investments by maybe investing in equity funds, not going trying to get rich quick. That's a mistake. You'll probably end up getting burnt quite badly with that. Another lesson is not setting financial goals and planning. Now, when you're young, you don't want to plan. But 20s and 30s, let's be honest, when you're in your 30s, you're not particularly that young anyway. One of the lessons that people look back on and wish they'd done is planned for the future. The older you get, the more you suddenly realise the benefit of planning. So if you want to buy a house, if you want to earn more money and be more wealthy in the future, you've got to make a plan of how you're going to achieve that. There are all sorts of costs associated with buying houses, whether it's stamp duty, solicitors' fees. You've got to try and make a plan to be able to pay those things in the future. If you want to have children, maybe you want to be able to plan for the future. So one of the lessons of age is the idea of planning and putting a plan in place. It doesn't have to be a negative thing. It's just having some fallback, some contingency plan in place. So there's one that I always talk about to people about careers. So you've got to have a contingency for your career. Mine was always doing exams. So I favoured a career where I could do exams. Therefore, my wages should, in theory, increase the more qualified I became. And so that was a plan, a deliberate plan that helped me along the way. One of the things I would say about careers as well is when you're young, you've got more ability to take risks in terms of, I don't like the term, but side hustles. So don't spend your time watching EastEnders. Do try and build things in the background that could be your out. The one thing I did start to learn as I got older is that life is very much like poker. So you've got a bunch of cards in your hand. They aren't necessarily the best cards. They might be the best cards around the table. And you've got some in the middle of the table that you're going to try and make the best of. You can bluff your way through it. But ultimately, the person who wins isn't the person who has the best hand in life. So when you play a poker game, you've got to give yourself the best out, the best chances of winning. And in life and careers, then that could be by doing something on the side. Now, like I say, I don't get into the side hustle porn idea where people go on and on about it. But Money to the Masses ultimately was that. So when I had a career and I was doing something I enjoyed, but I started to build Money to the Masses on the side as initially as a blog, and then it grew into what it is today. Now, if I hadn't done that, then I wouldn't be sitting here doing what we're doing at the moment. So always do these things. When you're young, you have less risks. You don't have the mortgage necessarily you've got to pay, or your spouse or kids that you've got to be able to feed. When you're young, you don't have those responsibilities, so you can take risks. Don't be reckless, but what I'm trying to say to people is don't be too conservative about things. It's the time when you can do it. The one other lesson I wish I'd learned was good debt versus bad debt. We talk about that on podcast 297. I live beyond my means on credit card debt. I never repaid it every month. The other lesson, I kept accruing debt. I'd maybe have some savings alongside it, but I always kept accruing debt. I never paid the debt off. I didn't learn the lesson of good debt versus bad debt. Now, if you don't listen to 297 episode, the simple concept is that good debt is one that can improve your financial position in the long term going forward. So that could be something like a mortgage, or if you had borrowed money to be able to do a course that would be able to improve your education or something like that. Bad debt is just buying things that don't do that. So borrowing money to be able to go and buy frivolous things. So good debt also usually comes with a plan of how you're going to repay it. And it also is normally planned in advance, and you shop around trying to get the best deal. So you get a loan to be able to do it. So I wish I'd learned that, because I accrued too much bad debt over time. I wish I'd learnt the idea of borrowing for cars, placing too much emphasis on buying a flash car when I was young. And actually, if I'd rather than do that, if I'd bought an okay car and put the £200 a month payments aside into investments, I'd be so much better off and be able to buy an even bigger, flashier car than I could do now. So, I mean, being silly about the car thing, I don't really value cars. But my point is, you'd have the money that would give you more financial freedoms now if I'd put away that money I used to spend on cars when I was in my 20s in investments. I would be more likely to approach a period where I'd be financially free, where I could choose whether I worked or not. The other thing I would highlight, I learned over time, is the importance of owning assets. So if you want to try and increase your wealth over time, the way to do that ultimately is to own assets. So that might be property, but it may be other things as well. It's not cars. trust me, it's not owning cars. You end up losing money in cars ultimately. So that is one of the things that I learned over time, trying to be able to invest. That is effectively you start to own things, shares, but actually trying to own other things as well. So try and build a pot of money that you're going to be able to do something with, because then your money is earning money for you while you're sleeping. The other thing is, I mean, this was debatable. This wasn't one of mine, but this was one that I read in a couple of places, was moving out of home too soon. So I think the idea behind that is that rather than going into rental, people will be able to save that money and be able to buy property when they were able to afford it. So they weren't actually stretching themselves. They were able to build up a sufficient deposit, etc. The jury's out on that one, in my view. There's a lot of positives sometimes for moving out of home. You learn a lot of valuable lessons, but it will slow down your ability probably to own a home. But one thing I would say on the flip side is that the lesson by going to university that I learned was my standards of accommodation that I was willing to accept were far lower than they were when I was older. So I know people who are in their 30s now buying their first houses, who are still living at home maybe, are expecting standards of accommodation that is similar to what they're used to, that their parents have, who are much, much older and have saved up all their life and moved up the property ladder. Whereas when you're younger, your standards are slightly lower and actually you get on the property ladder perhaps a little bit sooner, which therefore you are able to build your equity in property. So there's no hard and fast rule on that one. I think that's a personal view, but they were the broad money mistakes to avoid in your 20s and 30s. If you've got others, there will be others I'd love people to share, then please do send them in to us via email, Twitter and that. We can add them. We may even do this as a piece. We'll go and look at the 40s and 50s, the money lessons, and particularly there are plenty of money lessons I could share being in my 40s that I wish I'd learned as well. But we can also benefit from people who are older, who've already experienced those lessons they wish they'd learned.
Okay, so the next piece we're going to talk about is financial apps. And we've done lots of research over the years. We've got lots of different articles, and there are tons of different financial apps you can get. There are budgeting apps, cashback apps, investing apps, banking apps. So Damien, you're going to kind of run through the things in this piece that really people should be looking out for, the things that you wouldn't necessarily spot on the download page on the Apple Store or on the Google Play Store.
Yeah, so I wanted to run through some things to check when you're looking at whatever it may be financial app-wise. So like I said, pocket money apps, budgeting apps, banking apps, investing apps. So this is just not a complete list, but these are some of the things that me and the team look at when we're looking at these apps. So let's start off with the pocket money apps. Now, first thing I would do is keep an eye on costs. So these are the apps that you can use to give pocket money to your kids. They get cards they can spend, and some of them encourage them to do chores to be able to be paid. Now, most of them charge monthly fees, but they also charge additional top-ups as well. So sometimes when you add money to the cards or you give your money across to the children. So you need to make sure you understand what those fees are. They can be as much as about £25 a year for the standard fee for using the app. But there are alternatives which can be cheaper. One of them that you like, Andy, I think, is Hyperjar, which you've just started to use because of the cost differential, which does a lot of what some of the others do, but is free as well. And of course, Revolut Junior has just come out, which offer basically a free version of what a lot of these other apps like Rooster Money and GoHenry charge for. But there is something you need to check even on Revolut Junior, because some of these apps that may be free won't give you more than one account. So if you've got more than one child, then you may have to go for a paid version of them. So there are pluses and minuses to each. The other thing I would also add is beware of the lack of FSCS protection, so the Financial Services Compensation Scheme, which will protect your money at a regulated bank if they go bust. So we always say check whether your money is protected. So if they go bust, up to £85,000 per single account, £170,000 for a joint account is covered and will be repaid to you by the scheme. But with pocket money apps, because they're not actually banks, then they're not normally covered by this. But what they will do is some of them will hold money in a segregated account covered by the e-money regulations of the FCA. So do be aware of that. Budgeting apps, again, we got a similar thing on budgeting apps, is don't overpay. Now, there are apps that, Emma app, I quite like Emma app. It's a little bit more gamified. It's much easier to use. We've covered this on the Money to the Masses website. We'll link to our article on the best budgeting apps in case people are interested. They can see our views on them. But there is a charge of £59.99 a year if you want the full bells and whistles sort of premium access, which gives you access to features like customizable transactions. But I'm a bit of a fan of Money Dashboard, because Money Dashboard, although it's a little bit more work you need to put in, a little bit clunky, it's still pretty slick though, in my view. They give you all these additional features for free. So you have to look at what you're getting for what you're paying and the sort of user you're going to be. Are you more likely want to customize things yourself? Is what something like Money Dashboard going to be enough for what you want? Or are you happy just to stick with a free, more gamified version of an app like Emma? Data privacy is one of the things you have to bear in mind as well. All of these companies use or tend to use open banking to make sure they do, so that ensures the security of the connections. But you also need to check what they're going to do with the data that they receive. And Money Hub is an interesting one, because if you are sensitive about the use of your data, then you can pay a 99p a month subscription in return for keeping all your spending data private. So that's something slightly different if you're a bit sensitive to what's going to happen with your data. Beware of in-app offers. So a lot of these budgeting apps will make money by offering you goods and services within their apps, and you could find them cheaper elsewhere. To give you an example, Emma is offering a £2 cashback when you order pet supplies from towels.com, whereas if you go via Quidco, which is a specialist cashback app, there's an exclusive for nearly £20 cashback. So don't just go down the route of using the in-app offers that you get. That goes the same for banking actually as well, which we'll come on to a little bit later. The other one, Lauren picked up this one, is watch out for auto enrollment. So this is something you get in some of the apps, which actually Chip is the main offender, where what they'll do is they'll auto enroll new users into its paid for plan, which costs £1.50 a month. So there's an initial 28-day free trial. Now, after that free trial, if you like it, then obviously it will just carry on and you have to keep paying. But if you want the free version of the app, which is going to have less functionality, you have to downgrade. So it's a feeling that you're almost being forced into the paid version, and there's a choice of downgrading, which is counter to what lots of services do, where they make you choose to upgrade into the premium services. So beware of auto enrollments. And roundups and overdrafts. There's an interesting dynamic where you can round up your spare change and save that money. But when you get interactions with overdrafts, you need to check how that works. So some services will allow you to still round up your purchases even when you're using your overdraft. So you might be living in your overdraft, which is never a good thing. And they allow you to round up those purchases. So if you don't want that to happen, then you need to go and turn it off. So that's something to be aware of. Investing apps. Now, check investment choice, because a lot of the apps we come across have very limited choices, but also go and check who are the underlying providers of the investments themselves. So they all have normally a nice name for the plan or the portfolio, but fundamentally it'll be something like BlackRock that's lying behind it. And you can therefore go and look at the past performance of that plan. So always check your investment choice, check you're happy with it. Watch out for monthly fees, because some of the apps, particularly the likes of Moneybox, will charge a monthly fee of £1 plus a platform fee of 0.45%. And that's on top of the fund fees, which are normally between 0.12 and 0.28%. Now that fee, that £1, starts to rack up quite quickly. So that's £12 a year if you're only paying a few pence every now and then into the investments. It isn't so much of an issue if you start putting a lot of money into them. But then at that point, you might decide that you want to use a platform that gives you more choice. So it's not necessarily a bad thing. It can be expensive, is my warning. So check the monthly fees. There are ways you could perhaps invest in a more clunky way that avoids fees via things like Wealthify or whatever it may be, but they don't have the apps with the roundups and all the functionality. So something to bear in mind. Watch out for those fees. Check whether your interest rates are actually that. This was something Andy was pulling up when we were doing this piece. And Chip, for example, they show that they've got a 1.25% market return and say it's the best return in the market. But when you look into it, it's not actually an interest rate. It's a 1.25% bonus that is paid when you share a VIP pass to a friend. So in short, what they're doing is giving you part of their marketing budget rather than paying to accrue customers through other channels. They're using you, which is fine, but it's not an interest rate. So you just have to bear that in mind. They don't say it is, but the perception when you read it, you might think that that's what it is. But so you have to make sure that you understand what it is the return is based on. And minimum investments is another one. Make sure you understand what the minimum is before you sign up to any of these services. Some of them as much as £500, others are as little as £1. Now, moving swiftly on to trading apps. Now, you'll see there are a number that are commission free. So you see things like eToro, for example. But make sure you go and understand all the other charges that are occurring. So while the trade itself might be commission free, there may be charges such as withdrawal fees or currency conversion fees. So they all start to stack up. So there are charges there in the background, but make sure you understand what they are. And one fee that I'm never particularly a fan of is inactive account fees, which can be as much as $10 a month if your account's inactive for a year or more. The other thing I would say is check the products that you can get, because the tax wrappers, not all of them have, for example, lifetime ISAs, which I know are particularly popular at the moment with people trying to save for houses. I'll finish off with cashback apps and banking apps. Cashback apps, it's really the T's and C's surrounding about how the cashback works, because some of them don't work in conjunction with other offers. And also, it could take you quite some time, up to 9 months, to get the cashback from the apps. And banking apps, a number of them don't accept checks, or if they do, not via the app, but you have to do it via offline methods. So if you are somebody who still gets checks, I don't know if people still do. I mean, it's very rare to get checks these days, I find. But if you do, then you might want to make sure they do take checks. So Monzo in particular is a little bit clunky when it comes to trying to pay in checks. So just double check that. It's one of those things. It's the same for a number of banks, to be quite frank, but more and more of them are enabling you to pay in checks via the apps. Don't just use the marketplaces that they have, because a lot of them now, they make money via their marketplace. It's something we're going to see more and more of. They will make third-party services and products available. You might get a better deal by going directly to those people yourself, or even via us at Money to the Masses. There are deals that we get for people who listen to the podcast and read the website. So do always go and have a look on the site. We need to make a page actually where we highlight some of these. Final things, watch out for limits on accounts, for example, withdrawals via ATMs when you're abroad. So Monzo has a £200 a month fee-free withdrawal limit when you're abroad, whereas Revolut has a £200 per month or 5 ATM withdrawal limit. So you need to double check what the limits are and what the charges are. And the final thing is, they do actually offer incentives. If you love an app and you are forever going around telling people how good it is, and I know there are plenty of people who do that, because there are some really good apps out there, because they do have refer a friend incentives that you can make money from. So I'm not suggesting people go around trying to sign up their friends to services they don't want, but if you generally like something and you're recommending it, then you can make money in. Typically, it can be something like £25 for the referral. So why not make that money if you are going to refer them anyway?
And so for the next piece of the podcast, I'm going to be talking to Harvey. Now, Harvey has been on the show before. Before we get into that, let's welcome you back to the show. Harvey, welcome back. How are you doing?
I'm very well, thank you, Andy. Thanks for having me.
And so, Harvey, you've been on the show a few times now, but there will be listeners that haven't listened to the previous shows. There'll be new listeners as well. So could you just briefly explain what it is you do at Money to the Masses and why we've got you on the show this week?
Hi, Andy. Yes, of course. So I'm Harvey. I'm the personal insurance editor at Money to the Masses. And my background is that I've worked in the personal insurance industry for many, many years. My passion is giving people advice and knowledge about how to protect themselves against things like death, serious illnesses, and also things that protect your income, so income protection. But today we're going to focus on life insurance.
Okay, so as you say, Harvey, we're here to talk about life insurance, and you're specifically going to focus on reasons why you might want to review your life insurance.
That's right, Andy. So there are certain life events that happen when we need to review and reflect on our life insurance. It may be because we want to change the amount of life insurance we have, how long we have that life insurance for, or just who it's going to be payable to, who the beneficiary of that money will be. And these things do change with life events, and it's important that we go back and check that our life insurance reflects our wants and desires in the way that we feel is right for us.
Perfect. So you've written an article specifically detailing a number of reasons why you might want to review your life insurance. And we'll put the link to that article in the show notes today so listeners can go and read that article in full. So you're going to summarize that article now in the podcast and go through each of those key events. So what's the first one?
Okay, so the first of the events that we looked at was either marriage or a decision to start living with your partner, cohabiting and sharing financial affairs with a significant other can be, a significant event in your life, and it's one where you should reflect on what your life insurance is doing, whether it's sufficient, especially in situations where one person might be reliant on the other person's income to maintain their lifestyle. That sort of situation can have an effect on what kind of life insurance you need, how long you need it for, and especially on who you want to point that life insurance at in terms of a beneficiary.
And then conversely, there is another reason why you might want to review your life insurance, kind of the opposite, right?
Yeah, definitely. There's obviously the other flip side to that is divorce and separation. When people separate their financial affairs from one another, then life insurances need to be reflected on, especially if those life insurances were taken out jointly. A lot of joint policies have separation options within them, and we'll point to an article that shows you how to use those separation options so that you don't have to reapply for life insurances as such if you do go your separate ways. But even for separate life insurances, there's a need to reflect on what amount of cover you have, who the beneficiaries of those policies are. And in some instances, divorces can lead to things like maintenance payments being put in place for children. And it may be wise to consider taking out life insurance to ensure that those maintenance payments can be carried on if the person who's paying them unfortunately passes away before the child has reached an independent age.
And so, Harvey, you touched on there about dependents and children and decisions you'd need to make there. That sort of leads us on to the next one, doesn't it?
Yeah, Andy. So, the other significant event that we look at in our lives is starting a family. So whether you choose to adopt a child or you have a child, at that point, your mortality becomes quite important to you. So, you're suddenly responsible for another being, and you're probably going to be responsible for that being for at least the next 18 to 20 odd years. And that can be a reason why people look at life insurance. Now, for a lot of people, they might have put in place life insurance when they had their first child and haven't reflected on that life insurance as and when they've had their second and third or fourth child. It is important to reflect every time you have a child, because you want to ensure that there's enough money to maintain their lifestyles, to keep providing for them, but also you want to look at how long you set your policy up for. So if you've taken that policy, say, for example, for 18 years from the time that your first child was born, by the time you have concluded your family and had your maybe third or fourth child, that 18-year period might be too short to see your youngest to an independent age, and you may need to reflect on how long your policy will last for. So these are significant reasons why you should reflect on your life insurance if you add to your family.
So we've covered cohabiting, marriage, separation, having children. Let's focus on the financial aspects now. I suppose the biggest debts that people think about covering when they take out life insurance is their mortgage. So what do people need to do in terms of their mortgage? What do they need to reflect on?
Quite often, life insurance is a product that most people come across first when they go to buy a house, because they take out a mortgage and their mortgage broker will start speaking to them about taking out life insurance and buying life insurance to protect that very large debt that they're taking on. So mortgages, whether you're buying a new property and taking out a mortgage for the first time, or whether you're changing an existing mortgage, these are events when you should look at your life insurance, because if you have other people living in your home and they want to continue to live in that home and you're funding the mortgage, your death may jeopardize the roof over their heads, and you need to look at life insurance to protect that mortgage. Significantly, especially over this last year, we've seen a lot of people extend their mortgages, perhaps take out a little bit more money against their mortgage. So increasing the borrowing, or perhaps even increasing the number of years over which your mortgage is going to run, are reasons why you should reflect on your life insurance, because you may have increased the amount that's required to pay off your mortgage. And especially if it's the term, you want to ensure that your life insurance runs for as long as your mortgage does, so that it's always protecting that roof over your family's head.
And I suppose that moves us on naturally to the next question. We've talked about large debts, mortgage being most people's largest debt, but there are other debts to consider. And this is another reason why you might want to review your life insurance?
Absolutely, yeah. So any other debts that would require paying off in the event of your death, you should consider building those into your life insurance. And there are ways to do that in a cost-effective manner. If you review your life insurance, you don't necessarily have to take out policies for every single different aspect. You may want to consolidate some of those things, and sometimes it can make sense to incorporate some of your debts with your mortgage cover, for example, but taking some advice to work out how to do that comprehensively and in the most cost-effective way is usually the right course of action.
And so staying on the sort of finance side of things then, we've looked at debts. What about the income, the money coming in, occupation? This is another reason why you might want to review things.
Yeah, I mean, having a change in your income or, changing occupations altogether, most significantly for people who perhaps have gone down the self-employed route and started businesses of their own, these kinds of changes should prompt you to look at your life insurance, largely because if we're earning more, we're usually spending more. It means that our lifestyles require more money to maintain. So it might mean that life insurance that you put in place years ago doesn't really reflect how much money is required to keep your family in the lifestyle that they've become accustomed to now. Other things to bear in mind are also, if you change jobs, you may have had some employee benefits through your previous employer that you'd no longer have. So some employers provide something called death in service benefits, and you may have had some life insurance through your employer, which you may have given up. And conversely, you may go to a new employer who provides these benefits for free and you didn't have them previously, and perhaps that in itself warrants reflecting on the life insurance that you're paying for personally. But yeah, there are a number of significant reasons why you should look at your life insurance if you make some change in your working life and if your income changes. There are also instances where perhaps a member of the family who was not working previously starts to work. That's another reason why the family should reflect on their life insurance. Very often life insurance is put in place when we have children, and at that point it might be that one of the parents has decided to stay at home and raise their child. But a few years down the line, you find people start going back to work and have an income, and it may be that in itself requires some amendment to the life insurance that you've put in place for yourself and your family.
And so looking more towards the end of our lives and the reason why we might need life insurance for inheritance tax purposes. Now, this might be a new one for some people. Certainly we don't hear or read about it a lot. So why would you take out life insurance or want to review your life insurance later in life?
So for people that are reaching the later stages of life, inheritance tax becomes a topic of interest to them. So inheritance tax is what's payable on your estate. Everyone has a threshold of £325,000 that's available to them without inheritance tax. And if you're passing your estate to your spouse, then there is no inheritance tax that's payable. But in situations where your estate could be liable for inheritance tax, some people will choose to put in place life insurance and put that in a trust so that it's available to their beneficiaries and can fund the tax that will be payable upon their death. Now, there are a number of reasons why you should reflect on life insurance that you've put in place for inheritance tax. It could be that your estate has changed in value, so the inheritance tax applicable to your estate has changed. That needs to be reviewed. But you may have also made some gifts during your lifetime which become potentially exempt from tax and are only liable for tax for a period of time. And obviously, life insurance is not the only way to address your inheritance tax liability applicable to your estate. There may be other ways that you can mitigate and arrange your affairs so that the tax liability is reduced. And there are a number of these ways and methods discussed in an article that we will also link to this piece.
Okay, so that's great, Harvey. We've covered some really good reasons why you might want to review your life insurance. we're just going to finish off this piece. You're going to give a few tips for some people who might be looking at their life insurance and want to just simply lower their premiums. How do they do it?
Yeah, reflecting and reviewing on your life insurance might not save you money. In some cases, it does, because, you realize you've got more cover than you need, or, it's running for too long, and you can perhaps review things that will reduce the cost of your life insurance. But there are significant things that will reduce your life insurance premium if you approach somebody to review your life insurance. The first of those is the fact that you've given up smoking. So if you were a smoker when you took out your life insurance policy or you bought your life insurance, at that time you will have paid a smoker rate. A smoker is somebody who has used tobacco or nicotine products within the last 12 months. That includes vaping. So if you had to tick that box on your application form when you initially bought your life insurance, then it's likely you're paying smoker rates. Smoker rates are almost double what a non-smoker would pay. And if you have succeeded in giving up smoking and have been without nicotine or tobacco for at least 12 months, then you should review your life insurance, because it's very likely that you'll make a very significant saving on what you're spending. The second way that you can look to lower your life insurance premium is if your health has improved, or if a significant amount of time has passed since you had a health event. So if you're somebody who applied for life insurance and at the time you were suffering with poor health, or you'd perhaps just had a significant health event, something like a cancer diagnosis or a heart attack or a stroke or something significant, then the further away you are from that event in your life, the less risk you pose to a life insurance company, and therefore the lower the cost of that life insurance should be for you. So it is useful to go back and reflect on policies if the cost of that policy was increased at the time that you bought it. And then lastly, Andy, we also see that for some age groups and significantly across the board, some rates have reduced for life insurance. So it's a competitive world. Insurance companies do try to beat each other on premiums to attract new business. And I think that from time to time, it is valuable, just like we do with most of our other insurances that we have, that we go back to market and just check that we aren't paying more than what we should be paying for the life insurance that we have, because you may find that the rates have reduced and there's just a natural saving to be made without any change to your circumstance or to the policy that you have in place at the moment.
Harvey, that's great. Thanks ever so much for coming back on the show this week.
Thank you for having me, Andy.
And so, Damien, bringing you back in, we're pretty much done for this week, aren't we?
Yeah, so, Harvey's piece was brilliant, but we are going to get Harvey back in a couple of weeks to talk about whole of life as well. So if you have any questions about whole of life insurance policies, because there's been a big thing in the Times of late. So the Sunday Times have been doing lots of things about whole of life policies, very negative about it. So if people have questions or anything they want to fire into Harvey, we're going to cover it in a podcast in the next couple of weeks. Typical things like, should you continue paying your premium? So thanks to Harvey for coming on the show. But that is it for this week, Andy. Quite a long podcast this week, bit of a special. But yeah, you can contact me in the usual way, Damien@moneytothemessage.com, Twitter, Money to the Message with the number 2, Instagram, Facebook, TikTok. We're down with the kids these days. And as ever, please do review the podcast, because it really does help and it is very motivating for me and Andy. So until next time.
Until next time.